Hi, everybody. This is Walid Al-Bashir, and we are here at this session about startup funding mechanics to raise money in GCC. And we are going to discuss a couple of topics. Let me share my screen. Okay. The event is brought up to you by Founder Institute GCC, and the link for applying for the Founder Institute is just down here, fi.co/apply/GCC. This is for the next cohort. So our agenda for today is that we're going to welcome the Founder Institute and introduction, and then speaker introduction, panel discussion, and audience question and answers. Founder Institute is the world's largest pre-seed accelerator in the world. It's been in 95 countries up to now, and it has about 25,000 mentors available. So you've got access to a lot of mentors globally. It has helped about 6,000 portfolio companies come to life, and it has generated $35 billion of value. One of the core activities, entrepreneurs can create real impact on society. But most startup fails because they lack expected feedback and proper focus during the early pre-seed stages. Our program helps pre-seed founders and teams to traction funding through a devoted support network and structure growth progress. Founder Institute with VC Lab bring up the accelerator experience and the large VC firm creator in the world. We're going to start, we have another two events. One is in 8th of December, 5:30, which is a startup grind, and Dubai Xmas, Christmas party. This is an in-person event. And we've got the female founders, pitch your startup to GCC investors and expert on 13 December. I would like to introduce right now myself. I'm Walid Al-Bashir. I'm the managing partner of Intuitive Ventures. I'm a co-director of Founder Institute, GCC, and I would like our fellow panelists to introduce themselves as well. We could start with Sonali. You can unmute yourself, Sonali. Yes.
Hi, sorry, I'm Sonali. And I'm currently heading VC and PE at Panthera Capital, which is the investment arm of Fujairah Holding based in Dubai. And I've had a 15-year stint, across banking, across alternative investments of various kinds, and in emerging markets across Singapore, India, and GCC. So yeah, nice to be here, and look forward to the panel. Walid, I think you're muted.
Okay. Swithal, you could carry on introducing yourself.
Hey, good evening, everyone. Good evening, my co-panelist. Good to see Sonali, again. So yeah, my name is Shwetal Kumar. I've been living in the UAE for almost 2 decades now. I spent predominantly my career with Mubadala Investment. It's a sovereign fund based out of Abu Dhabi. Involved in most of the large deals, and worked in mostly strategic G2D, brownfield, greenfield side of investments. 2019, I was involved in even setting up Hub 71. I was seconded by Mubadala. After that, I fallen in love with the startup ecosystem, and then I decided to move on, started Startup Skills 360. We position ourselves as an ecosystem builder, pretty much the same thesis of what Hub 71 got, but it's a wider focus, more in MENA, working very closely with startup, even global startups, and we kind of provide advisory support. We recently concluded a entrepreneurship World Cup, which is a community sort of a building exercise that we are doing. And we have collaboration with a German-based company called Eding for bringing the design thinking future thinking lab in basically to MENA in India, and also focusing on supporting the universities and all to identify young student talents who could potentially become a future entrepreneurs. So yeah, I mean, essentially that's a part of ecosystem building exercise that we're doing and that we are working on, and basically adding more and more verticals to cover the entire cycle of ecosystem building. So thank you. Thanks,
Great,
Walid.
great. And we come to Wes.
Hello, everybody. Thanks, Walid, and the Founder Institute for having me. My name is Wes Follier. I'm the co-founder of a technology policy consulting firm here in the UAE. I work across the Arab world, anywhere from Mauritania through to Iraq, but also increasingly in South Asia, India and Pakistan, and Southeast Asia. We have an office out in Singapore, in fact. That's my day job. My night job is I'm an angel investor, very active investor in about 40 different companies. I prefer emerging markets, adventurous markets like Venezuela and South Africa, lots of markets obviously in the MENA, India, and Southeast Asia. And I generally focus on fintech, consumer B2B SaaS type businesses, pre-seed and seed. Thanks for having me.
Great, great. Thank you for the introduction, fellow panelists. I think Dubai has gone a long way, building the ecosystem since I think the earlier days in 2000, 2007 or 2008. I remember launching one of my startups in 2004. And that time, there was literally there was no any of the support that most of the founders they get today. So it's been a successful journey down the line. Would like just to get some vintage moment and talk about, how did this started? What was the main key milestone that has been significant for this ecosystem to move forward? So who would take this maybe?
Yeah, I've noticed something interesting. I'd be curious to hear your opinion, Walid, and the other panelists. That there's been this transition of dialogue about the Arab entrepreneurial ecosystems over the last 15 years that I've been in this region, which is one that people shied away from failure, shied away from entrepreneurship because there's a lot of social pressure to sort of be tracked into government positions or more traditional career paths. And I think over the last several years, like that sort of narrative has disappeared. And I think ultimately it was not true to begin with. And once you sort of go deeper into Africa, you found Arab entrepreneurs there. You find Arab entrepreneurs making up 95% generally of most economies in this region. So that's kind of been a really big transition. I think over the last several years to now what the digital economy is here.
Yeah, I think the region being like mostly a real estate or trading economy, it's been a great move forward, getting to understand the digital economy and stuff like that. Sonali, I'll take your views on that as well.
I completely agree with Wes, and I think maybe one of the reasons for that, especially in the past, let's say 2 years or so, has been the entry of governments, institutions, corporate venture capital, who have started investing in startups in this region. So this region was always traditionally an LP market, but LP market that has started investing in this region itself. I think that impetus with the government incentives and the corporate venture capital structures taking a strategic view as well. I think that has given a lot of impetus to the ecosystem as a whole, because that actually means that PC has become an integral asset class for everyone now. And I guess that's been one of the reasons why, more quality founders are coming up. And, now everyone, just about everyone wants to start up in just about every sector, not just the traditional sectors like e-commerce and food tech, but now we see innovation in this region in just about every sector.
Great. Swethal, I think Sonali spoke about the support and in terms of government of Sovereign funds or wherever, or maybe you could also elaborate more into this being on the both sides of the story, during your journey.
I think the first thing need to understand what is ecosystem. I think that's clarity also needed, and in my view, that is what now we seeing more and more clear nowadays. When you talk about the ecosystem, generally you would see key enablers. Those are important for developing the ecosystem, such as regulator, government bodies, accelerator, incubators, corporate innovation lab. Sonali mentioned about the venture capital, corporate VCs, even academia plays a bigger role. And there's a whole support functions, the service provider, all, if you put together all, that completes the ecosystem. And that is what actually we've been missing for a long time, actually. I mean, the Kareem and the story or Soup story, I would say that they were pretty much on their own. I think they set an example of being a great startup to be invested, but they were pretty much their own. There was no support functions. In fact, a lot of even investors were not even ready at that time. The maturity of, or in fact, the risk appetite were very low. But in fact, 2019, I remember 2018, 19, we could even count in your fingertip that how many Series A and startups were there. I mean, it was that low, Now we reach to a time when we can say, oh, now, we could literally count how many Series D startups are. So imagine from that time to now, the ecosystem is matured good enough. I mean, still very small in my view, but still that happened because of it's a government vision as well, top down. I can share some of the insights about how, we were looking at and we setting up Hub 71 because we didn't want to kind of have a kind of micro ecosystem, right? I mean, it has to be one ecosystem for Abu Dhabi. That was the vision. And a lot of inspiration drawn upon from Station F from Paris, kind of create all ecosystem where all the enablers actually be part of one pretty much as part of one umbrella, right? And that is where I like the model, because startup also feel that how they can tap whenever needed the key enablers, whether you need a, let's say, regulatory support, they are there. Whether you need a venture capital fund or you need to tap a talent from universities or academia, they are there. So I mean, that's exactly the generally ecosystem needs to be seen. I think Dubai started with I would say different ecosystem, but in my view, it's a lot of micro ecosystems there, and it's fragmented, to be honest. I mean, you see DTech is there, Astrolab, In5, DIFC. I mean, when Exposity was developing, at that point of time, scale to Dubai. So there are a lot of such programs are there, but I think sometimes it creates confusion, in my view, because I've seen a startup who's part of one ecosystem, they don't know what's going on in other, right? So I think that needs to be looked at, because you need to still at a city level or country level need to create a ecosystem where all are talking to each other, well connected, they get benefited from, even cross ecosystem. So I think that's missing, but in general, I think there's a lot of initiative has been done to see that all, how each one interact and, get support from each other. I think Sharjah is again, we have Ashera and SRTIP. But again, it's important that how they all will interact and support startup and the visibility of startup about what's going on other places is what, in my view, needs to be looked at. But it's maturing, which is a good sign. when we even concluded recently Entrepreneurship World Cup, we managed to pull, I think, player from multiple places, and we saw this UAE event. So it was important to bring everyone from all these ecosystems to support the startups. In fact, Sonali played also a vital role for the Entrepreneurship World Cup. Samir played a vital role. I think that's what we did that. So that is how I see the definition of ecosystem. And in my view, it's now getting bigger and bigger, and I see huge, I think, potential for in the MENA region that in next 5 years it will be. We can see that MENA will be in a global map.
Yeah, I think for founders, entrepreneurs, there's much more options as of today. I remember in 2011, I think we used to run something called Dubai Tech Nights in Meetup, and we only take a Throya hall, in DIC by that time, and we've got two startups come and pitch their ideas and one technical session, and pretty much things has gone through with a couple of startup weekends happening in 2012, 2013, and then we had the Ternate, the Creep, and the others, and then along with In5, I was lucky to be among the movement in Ternate for some time, In5 and others. But I think the ecosystem is evolving, and Abu Dhabi now has a very strong base. Dubai has a strong base. Sharjah with Shira and STRIB right now, and we see others like Fujairah, Sovereign Fund and stuff like that, which is really interesting. I think the options are getting more and more for entrepreneurs. Let's get into the topic right away. Sonali, if we ask, what do VCs look for? We've got aspiring entrepreneurs or maybe serial entrepreneurs also looking forward to see from a VC perspective, what would the VC look for,
Venture investing, as we know, historically it was an art, because all that VCs used to look for is the team. Team still is one of the most important factors. Team that has a spark, that almost has a dogmatic point of view on the problem they're trying to solve. But now VC has also become a science, because there's just so much information available, and so VCs have also started putting metrics down. And so VCs do look for, what is the precise tech space you're operating in, for example. What is the sector and the subsector in the region that you're operating in, and how well positioned are you to demonstrate traction already or going forward, whether you have what it takes to become a market leader eventually, etc. The other thing that VCs look for is basically, what are you coming with? So what is the traction that you've already achieved, or if you're a stage earlier, what is the PMF that you have looked at? So this is something that, upfront talking to VCs is an important discussion. The other thing is, which a lot of startups that we see don't put too much value in, but I think there's a lot of value is in getting the business model right. So get to the revenue drivers, get to the cost drivers. Now every VC has a very different way of analyzing their startups. Not every VC gets into very different detail, but from a startup perspective, it's best to be complete, because it also is a great learning process for the startup itself. The fundraising process is a great learning experience even for the startup, to fine tune its business model, to fine tune where it can get that value in for itself and for the investor ultimately. And then of course,
carry on, sorry.
And then of course, the other things like the right licenses, the right product, all of these together forming a complete picture is what a VC would look for.
Yeah, I think it started to be vetted to get into a VC stage, require a lot of a lot of milestones, a lot of KPIs and stuff like that. I just turn this to Wes, who has been doing several angel investment through the globe, and stuff like that. What is your entry level? What do you look at startup as an angel investment, and what are you looking forward to take them to next stage? Being varied, for VCs, or maybe taking them to the next funding round.
So generally, I'm looking at the team, the traction, the market, the same as Sonali mentioned. And within those three buckets, several different indicators of quality and capability and potential expectations about what might be the outcomes, right? So quality of the founding team, and I'm not one for looking at logos that you've worked for X, Y, and Z consulting firm or whatever. I'm coming from a background that sometimes that can be bad, coming from elite institutions, because sometimes those sort of founders are not able to cope well with very extreme challenges, and our region in particular tends to serve up some quite extreme challenges that, whether or not you were a top tier consultant, it's still going to be tough for you to work through those challenges. And many of those are made complex by just the interests involved. There's a lot of overlap between government and private interests, for example, in many of the markets here. I look at founder market fit. So is the business that you're building consistent with your previous employment background? Have you shown an interest in that area? Have you attracted a technical co-founder and potentially even another co-founder that have domain expertise? Are the people around you, whether they're advisors or initial angels, do they make sense? Are they going to be value add to the business? Are they going to make initial client introductions? Are they going to be able to introduce you to future sources of capital? Traction, when you're at pre-seed, you're looking at validation, some sort of signal of validation. Maybe that's in the form of customer conversations, but insights driven from those customer conversations, not a quantitative number of conversations. Letters of intent, MOUs, and the gold standard obviously is already some sales. And then obviously in a region like this where exit opportunities are still, and expectations about exit opportunities are still being calibrated because our venture markets are not that deep yet. Of course, you have to look at what are the exit potentials, what do they look like, and how big of a market is the startup and founding team going after. I think in that space in particular, it's important to be super realistic. There haven't been too many MENA startups who have truly been able to scale all the way across this region, right? So a lot of times you see UAE and Saudi in play, but the same founders who start from GCC maybe are not the best to scale to Morocco or Tunis or Algeria or even Pakistan, for example. So that's a bit of a glimpse at what I'm looking for. So a lot of different sort of not hard indicators or KPI, numerically different KPIs, but a sense that in totality, those factors make sense for me.
I think founder to market fit is one of the main things that you've mentioned, getting the founder and the team around them, fitting the sort of problem that they're trying to tackle in the market. And then, looking at the local components as well, and the diversity between, places like GCC and North Africa or stuff like that. These are really need to be tackled. I will just switch to Swethel. I think we're taking it from VC to angel investment. And then Swethel, they've been working on many programs with accelerators or with universities. And I think these are the entry point for founders to go into the journey. So what are the main characteristics that you look for in order to get those funded through to further, develop their MVPs, or maybe get angel investment or get it VC and so on.
So yeah, I mean, Walid, I'm also an angel investor. In fact, also we take some of the startups which we believe are investable to, the network of investors that we have it. I think the first important point, I don't want to repeat what Sonali and Wes have mentioned. Pretty much they covered all those as key elements. I think the most important is that how do you get investor to hear your pitch, right? That's most important, because there was a very interesting study done in 2000 by Microsoft. They said that, the average human attention span was 12 seconds in 2000. And they did another study in 2013 after 13 years. And they found that that attention span of human has come down to 8 seconds, which was even less than a goldfish, which is like a 9 second, right? So goldfish, an average attention span is 9 seconds. So imagine that, like how the human attention span is now coming down, and in current era, when we are like inundated with information, we have access to so many data, ample data. In this fast-moving internet era, our attention span is actually even come down to 5 seconds. The latest people say that the human cannot even listen more than 5 seconds any specific topic, right? So I think it comes to that point that now founders have, if they are pitching to any investor, but how can you grab their attention in 5 seconds? We talked about those days, 30-second elevator pitch. The pitching used to be 3 minutes, come down to 30 seconds. Now it's important that how can you grab the attention in 5 seconds? That is most important part, right? Now it is like that 5 seconds, how you can get them hooked, how can you create that impact on the investor to listen the remaining 25 seconds. That is where we reach to a point. Now, whatever the points that Sonali and Wes mentioned so far, I think all comes to the rest. So what is that you have? What really problem you are solving, and the solutions that you have, is the problem is something really standing out, or is it a me too? It's fine even if it's a me too or copycat, but it's relevant for this region. It may be successful elsewhere, but it may be relevant for the region. I think those are important. So when you're talking to investor, how can you grab that attention and say that, hey, you know what, this is what I'm trying to do, and you say, oh great, let me hear the rest of the things. So that then whatever the points that Sonali and Wes mentioned is our come to that, right? Once you understand the core problem that you're problem, do you have the right solutions? Do you have the right people to solve the problem? What sort of a technology you are using to kind of enable or basically disrupt that? And it's not necessarily that every startup has to be technology based, but even predominantly when it comes to the startup ecosystem, that what we see that. But even if it is a non-tech company, but what is your solutions? How it's differentiate from others? What's your competitive landscape? Why you are standing out? I think there are a lot of things matter from after that. Then come to the due diligence and various other things which once they start showing interest, they look at that. So I think in my view, beside whatever the points Sonali and Wes mentioned, I think important is to get their attention. See, even at early stage, when you're talking about someone who's coming with the idea, especially this region has a very less appetite to invest at ideation stage, by the way. You hardly found someone and say, hey, I can invest your money in your great idea, which is even, we need to see that going to happen perhaps in next 5 years or maybe a decade. But we are far behind the US market, Silicon Valley, right? But even to get that, we started seeing a lot of angel investor now coming. I think it's because of the awareness, which is great. We also doing a lot of awareness in our network, and I think we've seen that people who started investing at least 10% of their saving also now, right? Even look at the global trend is that alternate investment is considered as 10 to 15%. Even family offices started looking at that. This region, it was missing that, but it will come. I think it's awareness is there. I think it's gonna grow in coming years. But So what I'm trying to say that even with those early stage, it's important is to grab the attention. And then whatever the great points that Sonali and Wes mentioned, that needs to be considered factor when you're pitching.
I think that is very important, especially when the time is short. We see a lot of pitch competition and demo days in which very good ideas or products, they are not able to explain what they're doing properly. So normally it's like about problem, solution, why you, why now, all the whys, and then the business model, and then whatever comes after that, you could elaborate after giving all the pillars of your product or startup conveyed to the investor. Then you could come to elaborate on a specific topic. For the audience, anybody who's having question, he could put in the question and answer. We tackle them later. I will move to Sonali right now. Preparation for fundraise. I mean, what are the preparation? Want to do fundraising? Does the time matter and all this stuff? If you could shed some lights on this, would really appreciate it.
Right. I think the other panelists gave very good points as well already, right? But I'll just try to highlight a few probably do's and don'ts that I often see in the when people come out to, when startups come out to fundraise. So the first,
and why do they come to fundraise? I mean, they just wake up one day and then they see we're going to fundraise, or based on a specific events or a specific strategy that they decide to fundraise.
Yeah, absolutely. I think the timing to fundraise is extremely important. So my recommendation is don't start too early, because once fundraising starts, there's no stopping. Startups think that, oh, Series A is done and we are successful, but then it's Series B and Series C. Even after IPO, there's private fundraising that keeps happening. So don't start too early, because you have to start meeting targets. So what you really need to ensure is that even before you set foot to fundraise, all your brass tacks are ready. So you're ready with the right team, with the right product stage, at least a strategy of traction attack. All of these things should already be ready. Secondly, what are the type of startups that need to fundraise and when, right? Because there are certain startups with this business models that are already profitable at PC1, PC2, and sometimes even PC3 level without any expansion and without any spend on marketing. So if your business model is something like that, then wait. You can use that time before the fundraise to perfect your PMF, because your business model is already helping you ride this time, but if you are the kind of startup that needs to fundraise even to build, because you are an IP-based startup, etc., then start fundraising at the pre-seed stage itself. But be careful that you have the right investors, because as Shwetal was mentioning, that at the pre-seed stage there are very selective investors. So it's best to go with the strategic one. So let's say you're a health tech startup, go with a big strategic player in the market, an incumbent in the market that could probably have a vision in your sort of startup. So that's about the timing. And what are some of the do's and don'ts in the fundraise itself? One, the team that we were just talking about, make sure that your team is already complementary and complete. So both the things are necessary. The other thing is what goes in your pitch deck. So you can have a very generic pitch deck, and you can imagine investors get thousands of pitch decks every month. So what is it that stands out in a pitch deck or in your pitch? It's basically making a case of why and how your idea stands in today's environment, 2, locally in the region you are operating in, and 3, globally. So take out things like who are your global counterparts, and what is the funding going in your segment currently globally. A lot of startups say, oh, we don't have a clear competitor. My recommendation is, instead of saying that, make a chart with all your close competitors, list down all the features and functionalities and tick, and then demonstrate that how you are probably one of the best among the competitors, instead of saying that we don't have clear competitors. Talk about if you've already achieved some traction, highlight that a lot. Or if you have done a lot of work on your PMF, then highlight that a lot. And of course, TAM is important, the total addressable market. Apart from that, valuation, because before you set foot for fundraise, what is the valuation that you're going for, again, is a very important topic. So in valuation, research a lot, your sector, your subsector, again, the region that you're in, and globally, what's happening in your, the global counterparts that you have. And research these multiples and come up with a reasonable multiple. Ultimately, the valuation would be negotiated with lead investors. So be open, be realistic, but at the same time, be very tuned to the market so that you know where to be firm, where to stand your line, and figure out the other mechanics. Like, do you think that you should just go for a safe note, or is it already time to raise a priced round, etc. The last thing that I want to say is, which I've seen, that fundraising is a job in itself, right? So if there are two co-founders, let one co-founder just focus on fundraising and the other co-founder just focus on operations. Because the last thing you want is, during the fundraise process, your operations have taken a toll, which happens a lot. And in a team where co-founders are distributing these roles, it really helps, because while fundraising, if your business economics have actually gone up, it's just going to help you a lot in the valuation that's going to ultimately get negotiated.
Great. Any addition from Wes or Swiley in terms of the valuation, the process, the momentum, way to fundraise and all?
I'll jump in. I mean, one of the things that I even learned from the Founder Institute, and I think it's always important in this industry and sector, where no matter which side of the table you're on, that you're always learning. And one of the most interesting things the Founder Institute imparts is this concept of like building momentum in a fundraising process and having a lot of structure to how you go about that process. So this process of connecting with connectors, which are people who are embedded in the ecosystem or in the industry that you're solving your problem in, or you're building in, are able to connect you to people who angel invest in that segment. So and you're able to kind of systematically segment angels, and maybe you approach less favorable angels first, and meanwhile you're shaping your deck and refining and polishing your deck, refining how you pitch, how you present certain slides, maybe taking some things out, and then eventually making it to more strategic angels, and then eventually making your way to kind of pitching institutionals, and again segmenting them according to ones that you would really want to have on your cap table versus ones that are less preferred to have on your cap table, and kind of always gaining from each conversation either somebody else to talk to, or some sort of improvement that you can make to your deck, so that you sharpen your pitch, get better at walking through it, and ultimately wind up with being able to deliver that pitch, maybe even without a slide deck. So I really appreciate that sort of advice, and that the lessons that Founder Institute imparts in that regard. And then I just add to that, and building off of something Sonali mentioned, that one very weak point in most discussions with founders that I've found to be pretty frequent is when it comes to valuation, right? So being confident in the valuation discussion, and of course there are ways that people have been sort of taught in business to handle discussions that involve negotiation and not sort of naming a price. But in the realm of startups, from my perspective, if you don't have a good idea of what the valuation range might be, or you have not had conversations with other founders or looked at other market data, it sounds like you're not prepared. from my perspective, which I think is a bit different than if that's a negotiation around a contract, where if you name your price first, you get burnt. But in this case, I think it shows some confidence that to a potential investor that you've done your homework to have that conversation. Yeah.
Good. Swizzle, any addition on this point?
I think in my view, fundraising is a 24/7 activities. I mean, I'm sure if the founder is not raising, they are still thinking about raising. So the mind is always there for raising capital. Timing all depend on the stages, right? I mean, even today, when you see the startups, I mean, many of them, the founder, they tend to be intuitively paranoid, right? I mean, they're thinking that if I don't go, someone will go and raise the capital, you know. So that's sort of there's a rush there. I mean, if I delay by one more day, then absolutely, essentially, I need to raise fund. Is what the fear is that otherwise someone else would beat us to the punch. So those sort of a fear there. I think when you raise capital, the timing all depends on what exactly you need and what sort of a runway you're looking at, right? I think those are things to be assessed. So it's not that like, okay, because there's a capital, there's an investor, dare to invest. I also go and pitch it. But is it really necessary for you to go pitch at that time? Do you really need the capital? If yes, then you need to come with the really good homework. You need to analyze like what sort of investor, do some research, like what sort of investor I should approach. I think most of the investor typically, most of the funds typically basically publish their fund thesis, the mandates in their website, or talk to the advisor or people in the network who generally explain that what sort of the investor you should approach. So ideally, we should learn about what stages of business they invest, what's their fund size, what's their average check size, what sort of sector preference they have, any geographical preference, and what sort of the team size the fund got. So I think those are those sort of a homework which even startups should do before they raise the capital. Even in terms of the VC, especially when you look at a VC when they are at an early stage, they love to meet lots of startup, and they're happy to write usually small check. I mean, don't expect that everyone come and write a big check. They all like to kick the tire and find out which one is good before they want to also test the water. They want to see what sort of a sound stewardships that startup got, and how their investments are being spent prudently. So all those they assess before they write a big check. But initially, during early stage, you would see investor would like to meet a lot of startups. But as they approach toward the mid stage of their fund, they normally like to double down on the winners, right? I mean, they know that they have less cash left, and or maybe they are also thinking to start a new fund at a later stage. So those stages are also important to understand the maturity of the fund before you approach. And I think last but not the least, I would say that when you're approaching, you definitely need to go after a smart investor, not after the dumb money. I mean, the smart investor, the strategic investor bring a lot of values. So all those analysis assessment is important. So I think in every stage, so it's when you say timing, it's all depend on what's your requirements. And when you go for a fund, these are the factors in my view to consider beside what other things which Sonali and Wes mentioned.
I think, as Steve Blank said, startup is a temporary organization searching for a scalable and repeatable business model. So here, you bootstrap as much as you could do, unless you see either your traction is much higher than you could bootstrap, and by that time you figure out what is your burn rate, how much is monthly expenses. And based on that, you decide, okay, if I need to a run rate of 12 months or 18 months, then it will be probably that monthly expenses multiplied by 18, and you give another 30% or 40% contingency to help you raise another round. Some of the founders, they wait till they get stranded a lot, and then they start running out of cash. Then they do the fundraising, and the fundraising process itself, it takes from 3 to 6 months and sometimes more. So when you're doing it while you're doing the traction and your things are good, it's not like when you're doing it when you're running out of money and stuff like that. And then also times like holidays, vacations, and quarter ends when people are waiting for financial reports, or or you reach a zero cash debt. These are all times to avoid when you are doing the fundraising. I'll come back to Sonali for what are the pitfalls to avoid.
Well, I just want to add one point. I think one thing important to understand, when especially Sonali also mentioned about if you have a co-founders, let one focus on raising capital and other on the business. I think it's a very important point to be honest, because I've seen the founders now, they are so much burnout because, like I said, fundraising is a never-ending activity. You have a fundraising challenges on top of that, operational issue, people issues, technology, bottleneck, and a lot of things there. What I've seen recently, the founders are not taking care of themselves. Their health is deteriorating, which is why it's important that take a break, look after yourself, really see that why are you in a right path? Are you really is this the right time to do for fundraising, or focus on a business, increase the business? Those are the things important. But I think what I'm trying to say that health come first. I mean, to be honest, 3 years ago, when I left Mubadala, when we started this company, we came across founders extremely enthusiastic. What a great aura! They wanted to change the world. What a passionate everything. To be honest, recently I met them. I was shocked. He was like, looks like a drug addict. I mean, I said, what happened? So I think this is a pattern I'm seeing, that the young founders are extremely burnout. They are, not taking care of health. So all this is, I think, keep that in mind. So fundraising is important, but at the same time, think about yourself. And I think it's very important, valid point Sonali mentioned, that you need to create that role. Somebody should focus on a business, somebody should focus on the fundraising. If you do not have co-founder, at least identify a right team who should be able to do that, or West Point to get advisor, or people in the network who can help raising the capital.
Absolutely. I think one of the top VC investors had the first question he asked to the founders is that, when is the last time you took a break? Because that's bring up a lot of stuff regarding the burnout, regarding the wellness and all this stuff. Because again, if he's a VC investor, he's going to be with you at least for 6 to 8 years. So he wants you at least to maintain the beast over this 6 to 7 years. Otherwise, there's a huge risk in the startup and the founders themselves. Okay, could we talk about the pitfalls? I think I still want to keep like 10 or 7 minutes for questions. But again, briefly, if we could talk about the pitfalls, and what sort of preparation before you start fundraising. You need to reach out. You need to update the investors. You need to be visible in LinkedIn or in social media or whatever. So at least when you talk to investors, you have some sort of anchor. He has seen you somewhere, or stuff like that. If you could shed some lights on what are the pitfalls and what sort of preparation that you need to do in terms of investors update or stuff like that during the fundraising. If we could start with Sonali.
Right. So I think the biggest pitfall to avoid, is, I'll just repeat that, and what Shwetal rightly pointed out as well, is to actually plan your fundraise process carefully so that you don't get distracted from your core business. And the way to do it is, several. There's several ways to do it. One, having another co-founder or another team member, or like my panelist said, the advisor, and to help you, or even a venture builder. So the venture builder model, a lot of times, basically, they not only help you build, but they also help you fundraise. And another way to help you is to select the right investors and business partners in your first round, so that those investors are helping you build your next round. So, this is, going with the right, let's say, partners through your journey. I think that is going to help you avoid a lot of these other pitfalls.
Great. Wes, regarding investor update and the importance of it and reaching out and at least being a bit, visible, to where investors are.
Yeah, I mean, I think it's important to be positioned within the domain that your startup is focused, right? And I think probably the best way to do that in a scalable way is social media, and LinkedIn being a professional social media network. It's a great tool for that. And I think sharing information about the domain that you're building in is super important, because that allows you to sort of situate yourself amongst people who might be interested in that topic, potential investors, potential advisors. So I think that's super important. I think in terms of when you go out and start pitching those individuals, how you communicate with people who tell you no, who don't invest in your company, how you convince and communicate with people who are sort of on the fence, and how you slowly build this kind of supportive ecosystem around yourself as a founder, I think is super important. And one tool that's super critical for that is investor updates. And I prefer, particularly at very earlier stages, to see that on a monthly basis. And I think they can be incredibly useful to you from the very beginning of your funding process. So the people who tell you no, if they're strategic, you still want to keep them on your investor update list. If they're on the fence, most certainly you want to keep them on your investor updates list. And you want to share your progress on a monthly basis. It could be a particular insight that you've read about and you think it's interesting and it has implications. It could be that you've closed whatever 20% or 50% of the round, and you're using that investment update to drive urgency to close other investors. It could be product level team updates and things like that. So to me, good communication, I think is something that keeps you visible to the funding community. And I think the counterfactual to that is a very big pitfall is if you have bad communication, if you're not able to sort of like build momentum, build this ecosystem of people, of supporters who are rooting for you, then they're very ignorant on how they might be able to help you. And if people don't know how to help you, it's super difficult for them to be a cheerleader for you, to be an advocate for you, or to make connections. Because sometimes I think when you're in a business, it's like you think that the connection is clear to the industry and the types of people you should be meeting, and maybe you have an advisor or an investor, and you just may have that expectation, but a lot of people are super busy, and it's not clear. They need to have a set of asks, let's say, as part of an investor update that asks them for very specific forms of help. Like, hey, I'd love to meet Waleed at Intuito Ventures. Does anybody know him? So those kind of really targeted asks as part of investor updates, I think, are super important as well. So
Great. I do have a question here from Ihab, and I will hand it to Swetal. What about valuation? How is the valuation done in early stage startup normally when you pre-revenue, there's not much of traction or stuff like that. So what option do the founders have in terms of valuation at this stage?
I mean, valuation is sometimes very subjective when it comes to the early stage, right? I mean, you don't have much of traction. You don't have any historical information. I mean, so it's all about basically the discussion required with investors, saying that let's say comparing with the competitions and where you stand. At a very, very early stage, I think it's even very difficult to identify what's the right valuation, right? I mean, what I always suggest that if you are in a very early stage, when you're talking about pre-seed, seed, take accelerator as a benchmark. For example, if someone accelerator likes of Techstar or Y Combinator is investing in your company, right? They at the time when they graduate, they typically invest $120,000 or $150,000, take a 7% equity. That create a great benchmark to say that, okay, I mean, if somebody's investing in a company and saying that, hey, I want to invest, but I want 20% stake, so it's become a discussion, right? What value you're bringing to get a 20% stake, because it's very difficult to come to a number. What's my valuation is, right? I mean, lot of things is a forecast, lot of things is assumptions that you build in, but we have seen as startups or founders who just throw a number and cannot even justify where is that number come from. It's early stage is extremely challenging. So there's a lot of factors. So I think most important that whatever the valuation building come with a really, really strong assumptions, how you are going to build the revenue, what are the variables there to build that revenue model, how the cost you're calculating, what sort of tech elements you're building to invest, capex, opex, and everything, what sort of a manpower you plan to hire at the different stages. I think really that detail required to come with some sort of a backing, whatever the number you come and say that, yeah, this is the number I believe that my valuation come when I hit certain milestone, right? I mean, if you are raising capital and you are saying that, okay, I have a runway for, I'm raising this capital for a runway for next 6 to 8 months at early stage, which means some milestone you want to hit. And in that, you will see that, the business will move from A to B, which means my valuation is going to change. And that sort of a level of discussion required. It's really a two-way dialogue with, it's a negotiation with investor. Founders needs to be really bold enough to kind of push back, even if some sort of the weird equity ask come from investors. So yeah, in early stage, in my view, it's very difficult. There is no straightforward answer, to be honest. There is no kind of formula that you can say that this applies for any specific startup. I think the more you go toward scale up, I think you have historical information. You can build a base. DCF is the right model in my view at that point of view. But then there's I think a lot of other model, which hybrid model you adopt when you're discussing with the investor. But whatever is there in when you go to the VC or when you go to the any fund, always they will keep in mind that they will discount, right? It is not that whatever you are going to ask is going to be accepted. So there's always a pull and push happens.
Yeah, I think accelerators and incubators put a bit of benchmark at this level as well. As you mentioned, whether it's like $20,000, $25,000 for 7%, 6%. There's some resources that I came across to it. I think it was by one of the accelerators that's having a comparison of all the accelerators globally, which could be another thing is SafeNote, which is also another way to not to postpone the valuation discussion. But again, whatever the valuation, the founders has to know that this valuation will put a huge impact on the next round of funding, when they're raising funding. So if you stick to specific valuation and you successfully get invested, then you need to build the KPIs which will allow to justify this valuation during the line for the next raise. Otherwise, you'll have a sort of pullback into that. We've got a question here also regarding, there are a lot of conflicting stuff between gross against profit, and we see now again a lot of big techs that has been like the valuation, especially like IBOs and others, has drastically go down. So how do you see the future, and what do you advise the founders in terms of this? I mean, profit against growth, or what do you think, guys? Wes, if you could shed some light on this.
So I think, one of the most interesting developments over the past 6 months, of course, has been what's happening in the public markets and how the multiples in the public markets affect private markets. And then I would say a second layer to that is like, how does that articulate into emerging digital economies, right? So, we started to see as investors maybe 9 months ago, and I think you and I, Waleed, had those discussions. Like, we started seeing, top tier 1 investors pull out of Series A, like a year and 9 months ago in some geographies like South Africa and Nigeria. India has been more resilient, right? There's still people raising funds. There's still people raising a lot of money there. But even there is slowing up now, right? So the pace at which early stage and particularly pre-seed and seed stage valuations have been affected differ by country and by ecosystem, and also even by founders. So some founders haven't come to grips with those corrections. Others are more realistic about it. So I think that there's a range of spectrums. I think in my personal view, Q1 2023, there's going to be even more carnage. I think that valuation is going to dip further. I have seen that consistently across particularly emerging digital economies in the venture space, starting from 12 months ago, not even just 6 months ago. And I think for us sitting here in an emerging ecosystem like the MENA, like a lot of the information that we might see in the press from international sources is how those trends are articulating in very developed ecosystems. I think there are some unique challenges and unique expectations that we should be sort of building towards in developing ecosystems. And I think, unfortunately, it's going to hit harder in VC ecosystems that are more nascent, that don't have as much capital in them. And a lot of the big sort of Series A and growth stage investments have been done by crossover investors, tourist investors from Silicon Valley and Europe and places in between, who are investing in emerging markets for the first time, whether that was COVID accelerated or a mixture of the richness of valuations in more developed ecosystems. So I think that we're still not at the end of the road in emerging ecosystems.
Yeah, there's a question from Joyce. The question is a bit long, but I'll just summarize it. She mentioned that their pitch deck is based on US figure in terms of valuation and stuff like that. And we see now is still also Magnate and others. They're doing great job bringing up a lot of data to the ecosystem here. But again, in many areas, there is a shortage of data or open data in terms of the valuation, in terms of the stage, the amount invested and stuff like that. So how could the founders deal with this? I mean, like in terms of Joyce, question is like, she did the figures based on US. So they don't have the figures in UAE at the moment. So would they be changing the pitch deck, per region, or they just keep it standard? What do you recommend?
So I think it is important to tune to the region, especially this region where they do want to see a lot of times they do want to see what's your plan for the region itself, from a traction perspective, from a business development perspective. So the pitch deck has to be tuned to the region, in my opinion. And the other thing is that given the lack of data in emerging markets, what is really required is to be tuned to to other founders, to other people in your space. So I think that's where information, even investors get all the information from, by being tuned to the ecosystem, all the different players in the ecosystem, investors, founders, accelerators, advisors, so that's where you get, you find out at what stage, in which subsector, what sort of valuations are at play at this point in time. In the current times, like we were just discussing, that valuations are only looking to go down because interest rates are going up. Cost of capital is becoming high. And so at the end of the day, track to profitability is going to be more important than just, plain growth. So all of these factors are going to be, are going to come to play. And the only way to be switched on what to do and, what's happening is to connect with more people in the ecosystem. and really find out on, who's doing what and what are the other, who are your competitors as well, talking to even your competitors and actually figuring out ways to work together is also something that can actually really work in this region. Because if you see, no mega consolidations have yet happened in, most sectors. So that is going to happen at, some point in time. And so just being, switched on with the other people in your space, your competitors included, is really going to help.
Great. We've got a question from Raid regarding SaaS startup. I think they have a 3 years old SaaS startup. And then currently they are in final audit, final stage, like audit stage before launch. And their question will be, does it make a huge difference if they raise a fund at this stage or wait till they get subscribers from investors' perspective? Anyone can take this. I don't know who could be more appropriate.
I mean, I want to also touch upon previous question. I think it's a very valid question about data, right? I'll also answer this one as well. I think it was Joyce, right? Joyce mentioned about the lack of information. So I think this is important for a comparative analysis perspective. I think if you look at PitchBook or Deal Room or Traction, they have amazing data for matured market. I mean, US, Europe, India. But when it comes to MENA, I think a lack of information is available. Magnet, like Joyce mentioned, that it's building the database, but still long way to go. But I think even if you take those informations from Tractions or PitchBook, it's good enough to start with. But you have to consider various, when you do the discount rate, certain risk analysis needs to be done, risk factors to be considered, because this region, I think it is a really great book when it comes to valuation. Everyone should look at it, by Damodar. I think it's become a Bible of valuation, Damodaran's book. He publishes the list of the kind of country-specific risk, right? I mean, the risk when it comes to MENA, it is always high. Again, within MENA, which country you are in, UAE, Iran, or Syria, or Saudi, or Yemen, so it all matters, like within country, what sort of a risk level is there. So there's a political risk, there is a security risk, there is a various other factors which actually come into the discount rate calculation. So you should refer those books. Damodaran's book is great one when it comes to, and that too, when you want to really go to the nitty-gritty of the valuation, right? That deep depth valuation, when you want to do discount factor. In fact, Sonali mentioned about the interest rate is increasing, so hence you would see the cost of capital is going to be high. So when you come to that level of the valuation exercise, then you need to consider those kind of a risk factor. So if you have a comparative analysis taken from PitchBook or Traction or any other sources, that could be a good start. But then given that MENA, the risk level is very high, so generally you have to discount accordingly. I think the second question is about the SaaS. Sorry, you were saying, Walid, something?
Yeah, but the SaaS, there's a 3 years old SaaS startup. They are about to launch now. They're just doing the audit. Would it make a huge difference if they raise fund now or they wait till they get subscribers?
I think the SaaS business is important to show the subscriber early adoptions, right? I mean, why would someone go and subscribe for your product? I think that sort of a level of comfort needs to be shown. Because I think when it comes to the subscriber, when it needs to build out sort of a, the stickiness, what's most of the investor would be looking as a sort of a LTV that you create, lifetime value. And then when it comes to the SaaS-based platform, they want to see what sort of a amount you're going to spend to acquire the customer, what you call, typically CAC. So in my view, I may be wrong, but I think in my view, I think it's important to build the subscriber early adopter who, show some sort of a validations. Because if you are doing, there could be other one who also come and offer that, right? But how good is your product? How, what's the problem that you're solving using the technology that you can build the stickiness and add a lot of users, because it's a easy user game. You need to really add more and more user to the platform. So how are we going to do that? That's my take, but yeah, I mean, I would love to hear from others.
Great. I think we just crossed the time. I think with 5 minutes. We've got other two questions. If you time permit, you want to be respectful to your time, we could handle those ones, and then we could conclude. So one of the question is from George. How important is the story to successful pitch? How does one overcome, the negative perception around geographic region, for example? If anybody could shed light on that.
Sorry, what's the question?
I didn't get that.
Question,
I was about to say,
the importance of a story in successful pitch, and how you could overcome the negative perception around a specific region, for example.
Is that like he's saying that if he's in the UAE or MENA and pitching to US investor, and then the negative perception about the region?
Actually, is not clear, but if you could just talk about this, the importance of storytelling, in successful pitch, in terms of engagement, in terms of the sort of the attention span, stuff like that. The more you engage in, the more you compelling. What is the importance of the storytelling into the pitch process?
I think storytelling is super important. You need to have a right narratives. I mean, you need to be really good storyteller. But I think Sonali mentioned in the beginning that it's no more an art, right? I mean, it's a more art and science. It's a combination of art and science. Before it used to be says like, the fundraising is an art. It is an art indeed. Actually, there's more of art element than science. But I think now it's that investor would want to see that, what sort of how your art of pitching is backed by great science and data. So we covered a lot of points today, right from getting attention spans to the way, cascading down to the different elements that investor would look at. I'm sure you will share the recorded version. I wouldn't want to go and repeat that, but I think we covered that in great length, in my view.
Okay.
I can jump in on that if you want.
Okay.
In my view, storytelling is critical when you're raising funds, but I think it's more critical when you're running a business, right? Most good leaders are able to tell stories, to narrate why they started their business, to narrate the vision, mission, and objectives behind the business. That's really key to building a business at scale, getting people to support you, getting your first employees, which you might be taking from much bigger companies, motivating them to come and join, a small startup, which might be a fundraising deck and a website and not much more than that, right? So for me, the way a deck comes together, the way a founder presents their stories, why they're building their business, is indicative of the quality of the founder, of how they can communicate. And I think that has lots of ramifications for how they build their business, for whether or not they're able to engage professionally with investors at later stages. Because, one thing when you're pitching a business at pre-seed and seed stage, it's more reliant upon storytelling than later stages. But I think, it's also indicative of whether or not that founder is capable of engaging founders at Series D, Series E, when those communications need to be professional, business, and metric driven. So I think you better see some of the seeds of that in the way the story is told at earlier stages. So I think it's critical, and I think it has ramifications for all aspects of the business, including funding updates and how willing people are to support you, and how you write emails, and all of that stuff are signs to me.
Yeah, great entrepreneurs are able to tell stories always, whether on building teams or getting people excited or raising funds or selling products and stuff like that. Last question, it's regarding the localization, the local region. And then he's literally seen, speaking of business ideas being tuned to a local region, does it apply to specific domain idea, or that is a VC expectation? What I know that, premature scaling is one of the main reasons that startups die. So you need to own your own territory first. But eventually, if the idea like technology or edutech, which is it could be largely adopted in any region, is still, do you have to look at the local region first, or you just generalize it globally?
I think localization is extremely important, because the last thing that VCs want is copycats, right? There are certain ideas that work in demographics of the West, for example, which have actually no place in in not just emerging markets, let's say even GCC, and I can name a few as well, but we see these types all the time, and that is actually the one of the things that VCs shy away from, because at the end of the day, in all types of business models, right, B2C, B2B, every region is very different in how they do business, how the consumer adapts digital, and how the strategic or how the licenses work as well, right? So a fintech startup could actually think that they can easily expand out here, but there are so many things that come in play to really analyze what's going to, or what form is going to work in this region. And that doesn't apply to a particular sector or a few sectors. I think it just applies all the way across. So like I said, B2C, B2B, even licenses, even the sort of investors that are going to come on board for you when you have expanded in a certain region. But that is not to say that you have to completely rework your model, but you just have to basically customize it to the region, localize it.
Exactly. I think customer discovery, customer validation, and then these two stages before customer creation is very crucial, because as Sonali said, that even if the idea is proven several places in the world, but you need to take a lot of local elements in consideration when you took in the customer discovery and customer validation. Let's see, for example, here food delivery is done by motorbikes. In Europe, is done by bicycles. In some other places, so every region has its own particulars. Thank you very much, the whole panelists. I really appreciate your time. I don't want to drag this for long. Thank you very much for our attendees, and we're looking forward to our next event. Particularly, we have an online, we have a face-to-face event on December 8th. At 5:30, which is Startup Grind and Founder Institute GCC. It's basically a Christmas and NY meetup. And then we've got also the Founder Institute Female Founders Pitch Your Startup to GCC investors on 13 December. This is going to be a virtual event. Thank you very much once again, Wes, Sonali, Swetal. There has been an enlightening discussion, and looking forward to our next event.
Thank you.
Thanks, Waleed. Thanks, everybody.
Welcome, guys. Thank you very much. Welcome.
Bye-bye.